Most of you who've been with me before know my son Trent, and those of you who are in our tribe, Trent participates on our Friday Stock Talk. He's up visiting me, and we got to talking about the video I did yesterday where I said I'd give you $114 for your Amazon stock, and I notice it's up today. So in anticipation of their earnings report is why I did that. And he challenged me as to why, and I said because of their debt situation, their corporate debt. And so this morning I worked on a chart, actually going back because you had said, how do we anticipate when this debt's going to come due?
Right. I mean, how do you when did they borrow it? When does it mature? And then how do they refinance that debt? Because most corporations don't actually pay debt off. They just roll that debt continuously.
And it's not like you and we get a 30-year mortgage and get a fixed interest rate. That's not how it works. So I got to thinking about the software that I bought, the artificial intelligence software I bought that gives me the record of all the financial data on Amazon and 6,000 other stocks all the way back to 2000. And so I said, okay, what I want to do is look at how Amazon accumulated that debt since 2010 and thus try to project when it's going to come due. And I also understand the reason they have so much debt is because you're buying so much stuff from them. And that is they needed to build distribution centers. They borrowed money to do it. And their debt, as I'll show you, just exploded. Now we're looking back and saying, okay, let's say they're on a 5-year plan. What did they borrow in 2017 that's coming due this year, and how will that impact their bottom line? And then what was their cost of debt, and then how does that line up against their revenues? Okay?
Sounds good.
Then Trent threw something at me that I thought was, you said something about consumers. What did you say?
Well, you look at what is Amazon, why did they come into an existence? And that was to distribute books to the consumer at a better price point. And so they, started Amazon. That's where it started. Going fast forward to today, everything Amazon is doing is based on the consumer. The consumer is the root of their business, the foundation. So what's happening in the consumer world? Well, there's a lot of talk about inflation. There's a lot of talk about the cost of living going up. For me to go to the grocery store, it costs more today than it did a year ago. Well, if the average household has an income of $63,000 gross, take off taxes, and then figure they have like 2.53 kids on average,
right?
The cost of living is just escalating for them. So if we take a look at, back in, 2020, we saw a 32% increase in savings rates. Mm-hmm. Why'd that happen? Because of mailbox checks.
You bet.
You got all that. And then in March of 21, it was at 26%. So people were saving 26% of their income because they had additional income.
Right.
That correlates with Amazon's demand and debt increase.
Exactly.
Because they have to build out, right?
Yeah, right.
So now, when the average household is saving 3.9% versus 32% in April of 2020, they now have spent their savings down, okay, because they're not getting mailbox checks.
Right.
Okay. So now what are they defaulting to go pay for stuff?
Credit cards.
And if you look at credit card delinquencies, which I believe you'll throw up a chart of that, and consumer credit loans, the delinquency rates have just gone vertical in the last basically year.
Yeah.
So how does that affect Amazon and their level of debt?
And their revenues.
And the
debt, the cost of debt's coming to the bottom line. First of all, let's make it real clear. This is not financial advice. This is just two guys sharing their knowledge and their experience with you to make you a better investor. So what I want to do is show you the chart that I made this morning, the spreadsheet that shows the debt, and then equate that to their to a chart on their stock price and see if we can't see do I really want to give you $114 for your Amazon stock, or do I want to renege and bring it down below 100? We'll get right to that right after this.
Best of Us Investors presents Kerry Griegmeyer.
Okay, I want to show you the spreadsheet I put together this morning. And understand, I have bought some software that gives me access to everybody's, all 6,000 companies in the world's income statements, balance sheet, and that's where I got this data. What you see here is an analysis going back to 2010 of Amazon's debt, their interest expense, and their income and their revenue. And we want to see if we see any tie-ins together. And what I specifically want to see is, as they built these distribution centers, how did they bring the debt on, and then when is it going to mature? And the first thing I want to point out is 2017. And I want you to see that their debt from 2017 went from 15 billion to 37 billion. That's a 149% increase in debt. What would have to happen in your house to justify that? Well, you would say, because we moved up into a bigger house because we're making a more income.
Right.
And that's probably true. But there's a consequence. You're going to have to refinance that debt in the future. Back in 17, what were interest rates, you think?
Probably around 2 or 3.
Okay. What are they now?
Today, they're Fed funds rate is 5.33. Wall Street Journal's prime rate is 8.5.
Okay, so that's a 4x.
Yeah, it's a
3 to 4x.
Right.
So if this debt that they took on in 2017 of, what is it, 37 at that
37
point,
billion.
37 billion, and if they were financing that at 3, and now it's 8. What is it going to do to their bottom line? Well, let's look at what it did last year. They went from a income in 2021 of $33.3 billion to a $2.7 billion loss. What do you think caused that? I suspect it was refinancing of their debt, because if you look up here, their interest expense went up 30%. Their interest expense went up 30% in 2022, whereas their revenues went up 9%. If that happened in your house,
there'd be a lot of intense discussions with my wife.
right, and you would say, we've got to cut our expenses.
Right.
We've got to find any way we can. Get rid of the maid.
Yeah.
Get rid of the chauffeur.
Right. Right, exactly. I mean, talk to the kids about getting financial aid for their college education.
Yeah.
Instead of that's happening. Mm-hmm. That's happening. And so now there's more demand, for less. And so you're starting to see people, more garage sales.
Yeah.
They're selling stuff off. They're raising money.
Yeah.
You think about that. And you think about the acceleration of this, because what people don't really, I think, recognize at times is, when the Federal Reserve raises interest rates, the Fed funds rates, that takes 6 to 9 months to filter into the system. So if you go back to March of 22 when they started, okay, mm-hmm. All right, and you probably could look at your chart here and you could see in correlation with Amazon stock where in March of 22 where it was, okay? Mm-hmm. So think about this. We've had a major credit expansion, the availability of credit since 2010.
Right,
okay?
Right.
More money became more available in the expansion of credit. Now, in March of 22, Chairman Jerome Powell starts to raise interest rates anywhere from 50 basis points, 25 to 50 basis points at a time, and he's done that 11 times since March of 22. So that rise in interest rates is now filtering in, and you can look at like the S&P, Amazon, a lot of the Magnificent Seven stocks. And you can see the correlation of that interest rate move in the Federal Reserve, which then, as you're getting at here in this spreadsheet, is impacting the cost to service that debt.
Yes.
And now it takes 6 to 9 months to filter through. So we are just seeing, probably July of this year was the first time we're starting to see the effects of the first probably 3 rate hikes.
Okay.
So you can imagine, you've got 11 that have been hiked, and we've seen really 3 or 4.
The effects of 3. Okay.
Can you imagine the rest of them peeling in, bleeding into the system?
The analysts like to use the phrase, they've got some headwinds. Folks, this is not a headwind. This is a hurricane. This you said they're running into a wall.
Yeah, they are. I mean, because when you have the consumer spending coming down, right?
Which is Amazon's business.
Right. And you have the increase in cost, right? You're not getting a raise this year because the business you work for is slowing and they're having to service their debt, right?
Right.
Holy cow. It's like a category 10 hurricane.
Well, I was thinking this morning, it's like the pandemic. You woke up and all of a sudden everything changed. Right. And that's what's happening right now. And I don't believe that the pundits have recognized the impact because, again, it's so easy to see in the numbers how it's affecting Amazon's financial basis. But then when you think their business, not only their e-commerce is based on the consumer,
right,
and the consumer's being pressed, and then the companies that use Amazon Web Services also depend upon the consumer.
Right.
So that spending is going to come down. This is a hurricane. This is not headwinds. So I'm pulling back. Let's talk. Looking at the chart. On the price, where's their support?
Well, in my opinion, which is different from your $114 opinion of the other day, I believe Amazon in the $60, $70 range.
Oh my God!
Is ultimately where this is headed, and it's not just.
Wait a second. They're developing their own chip. They're artificial intelligence. Come on.
So. Historically, there are 3 things that create pivots in history. And so the first one is credit expansion and retraction. Okay?
Well, we had that. We had the $9 trillion given out on the national debt.
And now it's contracting.
Now we're only giving out $1 billion, trillion a year.
Social unrest.
Well, we got plenty of that.
And that has been building for 10 years or so in a big way.
Yeah.
Okay? Social unrest, we're seeing that today with now the third big thing that you see big pivots in history and economics and overall is war. We have 2 wars going on.
And another one
Ukraine,
being threatened.
Russia, and the Israeli and Hamas thing.
Right.
Okay. There could easily be a third conflict or something going on with China. But
yes.
Who knows? That's speculating right now, but the probability is increasing. We have these 3 big events going on. Jerome Powell's not going to lower interest rates.
No.
If you go back and you look at his position on when Bernanke and Yellen were lowering rates and they institute TARP, he was anti that. He was very against that. And so now you're seeing this policy that he is now in power, and he's looking at it going, we should have never lowered interest rates like we did.
Yeah.
We should have never expanded credit like we did. And now he's reversing it.
Yeah.
In my opinion, as long as he stays in the position he's in, he doesn't have to raise rates anymore. He has talked about raising them in December by another 1/4 point, but he doesn't have to. And it's because the bond market, the 10-year Treasury, is moving up in yield. So you got the value of the bond, and you got the yield, and it's like a teeter-totter. When the yield goes up, the bond value goes down. Well, China, one of the biggest holders of U.S. Treasuries, is selling off heavily the 10-year Treasury. And that's why the 10-year broke over 5% today. Okay. That affects the cost of borrowing money. Because you go to get a mortgage.
Right.
And they attach their spread to the 10-year. Okay. Right. So, I mean, the 30-year mortgage went over 8%. holy cow, I can't
Yeah.
afford a house
No.
on $63,000 average household income.
No.
No. Oh, and my credit card costs are going up.
Oh, my God.
Oh, and my credit line for my business just went from, 4 years ago at 4% to 12. This is.
This is a tsunami.
I don't even know if you can bring them all together. It's like Godzilla and whatever fighting each other.
Okay.
And I think that's where I look at Amazon's stock price and I go, man.
Yeah.
That's why I look at the $60, $70 range on Amazon.
Well, with that being said, I don't think either one of us really know, but we need to recognize what is going to happen on October the 26th after the market closes. That is Amazon's earnings call. Recognize that Amazon is going to be the barometer to tell us, do we have headwinds? Do we have a tornado? Do we have a hurricane? Or do we have a tsunami? We will learn so much on the evening of the 26th. Find a way to listen to that earnings call and hear the fear. I told you to listen to Elon's last week, and Elon's scared to death that he isn't going to sell any cars next year because you will not be able to afford them. This is something we need to be aware of. Okay, what's your price? How much are you paying for Amazon this week?
I'm not paying anything for Amazon. If I'm doing anything, it's taking the opposite side of it.
Oh, wow. Okay.
Which, for full disclosure, I do own December puts on Amazon.
Okay.
So
Okay.
I've held them for a while now.
All right. That's our dual
That's
take.
not a recommendation or advice, by the way.
Okay. That's our dual take on what we believe is possibly the investment opportunity of you and I's lifetime if we're in the right position as we go into the tsunami and then when it turns, because eventually artificial intelligence and machine learning will turn this whole thing around as interest rates come down and we initiate the revolution of our lifetimes. Artificial intelligence, machine learning, genome sequencing, genome editing, synthetic biology, but we gotta get through the damage that has been done in the past, and then we can reap the benefits. Anything you want to add?
I think this is presenting, if you're patient and you're willing to sit, in a liquid position, this is going to create an incredible opportunity. But the thing is, it's not going to happen today.
No.
But it will come. And when markets correct, they don't correct gradually, they correct rapidly. And I believe you're going to see we're moving towards the edge of the cliff.
Yeah.
Okay? And we may not see the roll off on the cliff until next year. But I really think it's important. One, this earnings call from Amazon is going to set the stage of where they're at. The really, truly incredible game changer earnings call that I'm waiting for is for first quarter of 2024.
Okay.
So
Okay.
it's a build-up. Just be patient.
Risk management is the word to take away. There's a lot of risk. Again, what are the three elements? Pivot points?
Social unrest,
Got it.
credit expansion and retraction,
Happening.
and war.
Developing. Okay, I'm Kerry Grinkmeyer. This is my son, Trent. We are both retired financial advisors. Our objective is to help you make better investment decisions, to keep more of what you make by understanding the tax code, and to help you build family wealth. We do that through our tribe. And if you want to become a part of our tribe, go to bestofusinvestors.com, explore our website, see what we have to offer, and see if you want to become one of us. It's all about getting on the bus.